Hello, I'm Annabel Brody-Smith, Communications Director of the Association of Investment Companies. Investment companies in the debt direct lending sector are known for their generous yields and specialist strategies. At the end of August, the sector offered an average yield of 7% and returned 16% and 44% over the last 1 and 5 years. However, less is known about the sustainable activity within the sector, such as the exposure to clean energy, affordable housing, and energy-efficient homes. To discuss their strategies, what they offer to investors, and the sustainable themes within their portfolios, I'm joined by 3 managers from the direct lending sector. Matthew Potter, manager of Honeycomb, Joanne Fisk, manager of GCP Asset-Backed Income Fund, and Thomas Legris-de-LaSalle, manager of RM Infrastructure Income. Right, on to the questions. What is your strategy and what does this offer to investors? And I'd like to ask that question to Joanne.
So GCP Asset-Backed Income Fund, or GABI as we call it, is a closed-ended investment fund which invests in asset-backed loans in sectors that we believe are structurally important to society. So that really encompasses a really broad range of sectors, which we broadly split into property, asset finance, social infrastructure, and energy and infrastructure, but can range from boilers in people's houses to Cng stations, student accommodation, and care homes. And what we offer to investors is a really diversified portfolio. So we have 54 different loans, and across the 6 years that we've been running the fund, that's been in 23 different sectors with risk-adjusted return. So we've been able to grow that dividend over the years, and the current dividend target that we're meeting this year is at 6.3p.
Thanks so much, Joanne. Matthew, what's your strategy and what does it offer to investors?
So Honeycomb aims to generate a high level of cash income for investors with a strong focus on capital preservation, as well as asset level diversification. What we're doing is providing finance to the non-bank lending sector, and that's a sector that's grown rapidly following the financial crisis, as the high street banks have retrenched from a lot of the traditional lending activities, which is now being occupied and filled by those non-banks who are better able to service the needs of SMEs and consumers. We also think that non-bank sector has an important role to play in creating a positive impact and potential for long-term and sustainable change in the UK. Our lending to these non-banks is all secured on their loan portfolios, typically on a senior basis from $0, meaning Honey produces a stable return even in volatile environments. The trust pays a consistent dividend of 20p per quarter, 80p per year, and it's done that since 2016. And that equates to about an 8.2% dividend yield with no missed payments. Overall, we think Honey offers investors access to an asset class which offers diversification to their portfolio, as well as an attractive risk-reward profile and strong income potential.
And finally, Thomas, what is your strategy and what does it offer to investors?
Well, in very simple terms, RM Infrastructure PLC invests in secured debt investments across 2 main sectors, and that is social and environmental infrastructure. So we're providing investors with exposure to critical infrastructure assets that are not correlated to the broader economic cycle. As part of our lending thesis, sustainability really sits at the core of our investment processes. And therefore, we always look to invest in areas where our investment and lending practices will have a meaningful and positive social and environmental outcome that are directly linked to sustainable development goals. So the lending that we do is very much, backed by real estate and/or physical assets. In fact, the portfolio, roughly 85%, is fully secured, predominantly on a senior secured basis. And we look to achieve this in the future against these type of assets. Now, the portfolio at present is £131 million of invested capital spread across 34 loans in 13 sectors. So very well diversified and seasoned portfolio. And I would say the investment management team have done an outstanding job in increasing the exposure to these core sectors, i.e. social and environmental infrastructure over the last few months. And I'm pleased to report that the portfolio is roughly now invested, at 50% within those core sectors. I would also mention that ARM Funds, to the best of my knowledge, again, is the only listed fund out there that's been accredited by the British Business Bank in regards to deploying a coronavirus business interruption loan scheme. And myself and the rest of the investment team, I would say, have done a great job in deploying £32 million of the receivables facility. And that's roughly 25% of the portfolio. And that's very much key because to our investors, up to 80% of these £32 million of invested capital are backed by contractual government guarantee. And lastly, I would say we aim to provide our investors with a stable and consistent dividend stream of 6.5p per annum paid on a quarterly basis, which I'm pleased to report that we've either always achieved and or exceeded since inception.
Thanks, Thomas. Those consistent dividends are clearly very attractive to investors. I'd now like to ask you and the managers, how did you manage COVID and then the recovery? And I'll kick off that question with Matthew. Thank you.
So our performance through 2020 was resilient to the COVID pandemic, and we were able to continue to pay those consistent dividends throughout, and we actually delivered a NAV return of 7.7%. The very nature of our strategy being senior secured, combined with the resilient asset class and structural protections that we use, means the risk of volatility at times of heightened financial stress is considerably lower. And we think the strength of performance of the portfolio was also evidenced by the cash generation that Honey achieved in 2020, where it generated 291 million of cash, which was actually higher than the cash generation in 2019. During the height of COVID, we put a pause on all new investments, and we used the cash generation to reduce gearing in the trust. And then as the impact of COVID on the economy became clearer, we were seeing opportunities that we thought offered pretty compelling risk returns with strong asset backing. So we started to redeploy capital in the latter half of 2020. If we look ahead to COVID-19 and the ongoing impact it's having, we think that it's only served to accelerate some of the structural changes that are happening in our market and our industry. And it continues to narrow the focus of the mainstream banks. And we think that provides opportunities for non-banks to continue to grow and therefore our market to continue to grow.
Right. So actually, bizarrely, COVID actually created some opportunities for you, actually. Would you agree with that?
Yeah, no, definitely. The structural changes that have been happening since the financial crisis, kind of COVID has only exacerbated some of the larger banks' issues. And it means that they've continued to pull out of markets that are kind of core to kind of SMEs and consumers, and non-banks are filling that gap. So we definitely think the disruption is creating opportunity.
Interesting. Joanne, how did you manage COVID and then the recovery?
Yeah, so at the onset of COVID, we kind of sat down and looked at our portfolio and worked with our independent valuation agent to agree some discount rate changes, which we thought was a really prudent approach to take at the time, given that we didn't really know what the impact might be across a number of different sectors in our portfolio. And we classified our loans as high impact, medium impact, and low impact. And then over the last 18 months, we've been able to unwind a lot of those provisions, which has been really positive, actually working with those borrowers to see that they can actually work through the impact that they were having on their businesses. And really, we've been really impressed with the management teams that we've worked with and how they've been able to manage those challenges. It has also opened up a number of opportunities for us as well, where borrowers within our portfolio have seen opportunities in their sectors. So, for example, to grow their businesses. So, for example, the care homes that we were working with are looking at new properties that they can develop into, and the children's nurseries that we support are seeing opportunities for them to grow as well. It has meant that as a fund, whilst we would normally be raising more capital, we haven't been able to do that over this period. So what we've been concentrating on is really effective redeployment of our RCF when we're getting repayments back through the fund. And we had a really positive year for origination last year as well.
Excellent. So opportunities for you too. Excellent news. And Thomas, how did you manage COVID and the recovery?
I'd say we've managed COVID pretty well, and the board and the investment management team were very quick to react and anticipate to the effects of the pandemic. First and foremost, and on a temporary basis, we suspended all new lending activities, and our key focus was very much the existing portfolio and making sure that we were preserving capital. But in addition to that, we wanted to make sure that we were providing the level of support to the investments as well as the company's management, whether that was in the form of providing covenant release where it was deemed necessary without necessarily releasing some of the other control mechanism and other key covenants that we have in the legal documentation, whilst at the same time preserving in full our interest income. I would say the fact that we've kept our dividend distribution consistent since inception of the fund, even throughout COVID, just shows investors how robust the portfolio was pre-going into COVID, during COVID, and after COVID. I would say, in addition to that, the status of the portfolio and the credit profile of our underlying investments are very well positioned for the reopening of the economy. In fact, I would go a step further than this and really state that the state of the portfolio is in a far better shape than where we were pre-COVID and during COVID. And I think that's fully reflected within the NAV market that we've seen over the various months. And we fully expect this momentum to keep going over the remaining of 2021 and 2022. Also, what that's meant is obviously we were pre-COVID seeing a lot of structural and social demographic changes, which ultimately created a lot of compelling opportunities for us. And really, COVID has just enhanced those changes, which really creates for the fund and ultimately for investors a very compelling opportunity set. And I would say one of the most promising opportunity set for the fund since the inception, allowing us to generate very attractive risk-adjusted returns within our core sectors, i.e. social and environmental infrastructure.
Yeah, that's very interesting. I think it's very interesting the point you make about the sustainability of the income through the pandemic. I think it showed that your risk controls and your strategy is working to have that. Thomas, I'm going to ask you another question. How do you stress sustainability within your portfolio?
Well, first and foremost, I would say that sustainability and making sure that the type of lending that we do and the areas in which we land have a meaningful and positive social and environmental outcomes that are directly linked to sustainable development goals that we're looking to achieve. So that very much sits at the core of our investment thesis. And in line with that, the type of core sectors that we're focusing on, social and environmental infrastructure, really sits neatly within that aim. So we're looking to address, for example, addressing the shortfall in supply of care home or aged care facilities with or without nursing, and making sure that the quality that we're providing is up to the required standards. And in line with that, we've appointed one of the leading independent providers, the Good Economy, which will essentially provide our investors with an annual report on essentially addressing whether RMII meets those sustainable development goals and in providing our investors with a positive impact score. And I'm pleased to say that during the course of this week, we will be releasing their interim report to investors as well.
Very interesting. I actually talked to impact investment companies in June. And obviously there's a lot of interest in this sector. It's great you're going to have that report so people can actually see what impact your investments are having on society and the environment.
Yeah, very much so. I mean, it is a lot of work, but we're quite happy to properly report to investors what it is we're doing, and all of this being done by an independent third-party provider rather than coming from the fund itself. So I think it's a very compelling proposition and offer to our investors base. Yes. Very
compelling proposition. We've just introduced ESG disclosures actually on the AIC website. So, Matthew, how are you addressing sustainability in your portfolio?
So, as I said earlier, Honeycomb's focused on the non-bank sector, and And we think that's a sector that has a really important role to play in creating positive impact and the potential for long-term and sustainable change. And we generally feel that that's been a bit overlooked as those businesses are enabling change for everyday consumers and the smaller SMEs, as opposed to some of the bigger headline-grabbing infrastructure projects. But we very much believe that if the UK is going to meet its ambitious goals, then this part of the sector is going to be very important. At Pollen Street, we collect data across all our credit portfolio, and we track impact against 5 key areas where we believe that our lending can make a meaningful difference. By way of example, a few of these, so financial inclusion. So a lot of the consumers and SMEs that our credit partners lend to are often underserved by mainstream lenders. And what our partners do, what the lenders do that we lend to, is that they offer tailored specialist products to fill that lending gap. One of our largest partners, by way of example, Iwaka, is an SME lender, and it's provided working capital finance to more than 50,000 small businesses since we've been supporting them. Regional economic growth is another metric that we measure, and we've provided 195 million via our credit partners to support the coronavirus business interruption loan scheme. And the CBIL scheme was designed by the government to support those smaller businesses as they were going through the shocks of the COVID pandemic. On affordable housing, we've built more than 2,000 affordable homes since 2016. And on reduction of carbon footprint, we've recently agreed a new £75 million senior credit facility to Europe's largest electric vehicle subscription service business called Onto. And that facility enables Onto to expand its electric car fleet, which helps to reduce the barriers to everyday consumers to being able to move from internal combustion engine to electric vehicles. So again, having a really positive impact on the overall economy.
Great to have those real examples there. And Joanne, how are you addressing sustainability within your portfolio?
So Gravis, as an investment manager, our kind of slogan is investments for the long term. So as a house, we've always looked to sustainable investments that are going to give a long-term future and have societal benefit. Within Gabby, what that means is that we're looking for assets with structural demand within society. So whether that's in social infrastructure, and we're looking at care homes in areas of undersupply, or we're looking to support new ways of providing affordable housing, for example, in airspace development, and working with local councils and the GLA to deliver that. Or it could be in the kind of energy transition space. And we've had quite a number of different investments through the portfolio. So, for example, we were a relatively early investor in sort of battery storage assets, which, whilst obviously not a renewable fuel source within themselves, are supporting the transition. And then one of the assets that we often kind of talk about as a case study, and I think which demonstrates really well our kind of investment strategy and how we embed sustainability in that, is our investment in Cng Stations. So we're invested in a developer who is building out Cng stations, which is compressed natural gas stations, and they're able to deliver fuel that can be used for large haulage vehicles instead of diesel. So obviously that has a direct displacement effect every time that you're able to take a diesel engine off the road and use these Cng stations. So with our investment, they've been able to grow, and we've supported a number of the stations that they've built out now. And that's an area that we're really interested in, and we're really proud of kind of the impact that that's had in moving away from a sort of carbon intensive fuel source.
And now we're coming to our final question. What opportunities are you most excited about? And I'd like to ask that to Thomas.
Well, I would really address this question in threefold. Really, the first one is we're very much excited and looking forward to grow the portfolio both in short to medium term, and really to match that capital that's looking to be deployed within that high social impact framework with the borrowers that are looking to raise this capital. Second really is around the niche market in which we operate, and that is very much what we would refer to as the missing middle, i.e., making non-benchmark loans to UK companies that have an active ESG management framework around their operations. And really, what that means for us is we're able to secure some very, very compelling transaction opportunities. In addition to that, I would say it's one of the most exciting set of opportunity that we've seen since inception. And I'd say lastly, ARM Funds is the only, to my knowledge, the only listed fund out there that's been accredited by the British Business Bank to deploy coronavirus business interruption loan schemes, and we've done a great job to date in deploying 32 million pounds of CBILS facility, and that's roughly 25% of the portfolio. And we're constantly engaging with the British Business Bank to explore new avenues, new ways on how best we can provide our support to UK companies in this post-COVID world.
That is really exciting and great to hear you're providing those loans to provide employment and opportunities to UK business. Really great. What opportunities are you most excited about, Joanne?
So the opportunities that we're looking at the moment are actually a lot of them working with our kind of existing borrowers and our existing portfolio to really help them expand their businesses. A lot of them have spent the last 18 months kind of consolidating and looking at opportunities that they're seeing in their sector. They've obviously dealt with the challenges through their last 18 months, and our borrowers are in a really good place, a lot of them, to then look at how they can expand and take advantage of those opportunities. So we're seeing really interesting projects in the care home space, in affordable housing, and actually mostly across the sort of social infrastructure space is where we're seeing kind of new opportunities at the moment. But I think as a fund, we're really excited about actually being able to move more back into that kind of growth mindset and not kind of looking just to manage the portfolio and kind of deal with our borrowers as the challenges they're facing, but seeing these opportunities and seeing opportunities to grow.
I think we're all looking forward to moving forward and being more optimistic. I can completely understand that. And Matthew, what opportunities are you seeing in your portfolio?
So we're excited about the potential for positive impact through the Honeycomb strategy, and we're also excited by the continued disruption and innovation that technology is bringing to the finance industry, and how that's improving customer experience alongside harnessing new data to make better, quicker lending decisions. We've been continuing to build relationships and improving relationships with our existing partners, and also developing relationships with potential future credit partners as well. We've got a near-term pipeline of about 850 million, including opportunities in the electrification of transport, financing to help reduce the carbon footprint of the existing housing stock in the UK, SME working capital loans, as well as real estate lending as well. And we very much believe that if the UK is going to achieve its goals and objectives around affordable housing, around regional growth, around energy efficient homes, as well as pushing forward and increasing adoption of electric vehicles, then financing is going to be a really important component of achieving that. And therefore, the non-bank lending community we work with is going to be key.
I think you're quite right. Some really encouraging messages coming through. And I wouldn't just think of the debt direct lending sector as actually having so much sustainable activity and ESG activity within their portfolios, and how important that's going to be for the future. Fascinating. I'd like to thank our three managers very much for joining us today. It's been great to hear more about their strategies and outlook. I'd like to emphasise that we don't know what's going to happen in the future. Investment is for the long term, and you need to have a well-balanced portfolio. If you are in any doubt, you should talk to a financial advisor. Thanks so much for watching.